Hi, welcome to mywealth.com. I'm Mike Conlon. I'm one of the senior instructors here with the courses. Welcome to today's blog. Today's blog topic is QQQ. Will it continue? In the midst of what's been deemed the greatest financial crisis of our time, there's one sector that has come back with a vengeance. This sector is represented by companies with strong balance sheets, excess cash on hand, and limited exposure to toxic assets. What is this conservative sector, you may be asking yourself? That's right, it's technology. A lot has changed since the go-go days of the late 90s, when tech stocks were high flyers and they soared to amazing heights, only to crash and burn once reality set in. Today, the reality is that tech stocks are here to stay. What was once speculative, highly volatile companies are now mainstays in our economy. This is part of the natural evolution of tech stocks, that the winners survive and prosper, and that the losers get acquired or eliminated. So let's take a look at how this sector is doing.
As always, be sure to check out the written blog at www.mywealth.com/blog. Okay, so the power shares QQQ, ticker symbol QQQQ, realize that's a little confusing. That's an ETF that replicates the Nasdaq 100 index, and it's become synonymous with tech stocks, and it's had a nice rebound here in 2009. It's up roughly 10% year to date, and it's up 25% from its March lows. If you take a look at the chart below, it'll show that to you. Okay. Now, conversely, the SPDR, the SPY, it's still down roughly 4.5% in 2009, but yet it too has rebounded. So if you take a look at the chart of the SPDR, you'll notice the same pattern. The difference being that the QQQQ is up 10% for the year, while the SPDR is down 4.5%. The SPDR represents a broader average of stocks in the U.S. economy than the QQQ, so that's the difference right there. There's some reasons why the QQQQ has done better than and outperformed other sectors of the economy. Okay, the first one is tech companies have lots of cash and they have low debt. That's very important right now when we see what's happening with a lot of the defaults going on, that companies have cash and they are able to pay their debt service if they do have it. Okay, the next reason is that tech companies have continuing profits from operations, maintenance, and licensing fees. It's not like a company's gonna stop paying for tech entirely. They have to continue their operations. A company that's facing difficult financial times may be more apt to lay off workers before they are willing to stop their tech budgets. So the reason for that is because technology promotes efficiency. Okay, now companies can get a little bit leaner and meaner, and operate more profitably with the advent of technology. Okay, tech stocks also have little exposure to real estate, subprime, or commodities. Those were the high flyers up until last year, and have had quite a fall off since that time. What's basically happened is companies that have large exposure to these areas have not fared well. Some examples are the financial sector, for example. Okay, and lastly, technology has become a necessity. Okay, how would the average person be able to function if they weren't able to log on to their PC, sync their BlackBerry to it, so they could Google the top 10 songs of the week to share with their friends on their iPod, yada, yada, yada. You get the idea. Okay, so don't wait. Get in a course, get educated, go to www.mywealth.com.
So as we can see, there are many fundamental reasons why tech stocks have fared so well so far this year. Whether the market bottom is in or not is anyone's guess. But what we do know is this: if this rally continues, it'll be because tech stocks are leading the way. So don't wait. Get educated. Go to www.mywealth.com. I'm Mike Conlon. Thanks for being with me, and I hope to see you in the courses.